Hi there, my name is Vance Williams and I've been trading and teaching Forex now for 10 years. You're going to learn things in this video that you won't learn anywhere else. How do I know? Because I developed the techniques. You know, that's the real reward of 10 years of experience. You see things other people don't. As an example, I'm going to share one of the most powerful techniques I ever developed, which I call new waves. Nothing is more accurate for helping you see the important behavior buyers and sellers are showing you. In effect, showing you their hand. Used correctly, the Fibonacci drawing tool is one of the most valuable tools in Forex trading. I use it more than any other tool. But like most great information, you have to know when and where to use it, and I'm going to share that with you too. At the end of this short video, I want you to know I'm also going to share something with you free of charge. I promise it's going to help you with your trading and you're going to love it. And what I'm going to share can save you years of wasted time, because you should know that thousands of people spend 3, 4, 5, 6, 7, 8 years and they never even figure it out. So do check that out at the end. Now for now, enjoy this session on mastering the Fibonacci tool. Okay, let's make this class interesting. Right now I'm going to show you a trading setup many of our traders took February 18th. That's just 2 days ago. They found and planned this trade based on the very technique that I'm about to teach you. It's really simple. You see a price move right here. Price, just follow my mouse up. Price moves, price advances the trend, it pulls back, and it pushes again. You're going to hear me say this is the most reliable and repeated human behavior in Forex trading. So you'll see as it makes a clear price move, it actually moves up. Let's see, it advances about 26 pips. It makes a pullback and then pushes again. All right, so the way that we would trade this, and not every member on our team would put their stop and entry and target in the same place, but you have a reason why you would target a particular area. You have a reason why you would put your stop loss in a particular area, and all of those reasons would have logic and probabilities associated with them. You have a risk-to-reward relationship that's important. And by the way, there's a high probability risk-to-reward ratio as well. Basically, when I say high probability, I want you to just think logic. And so what I'm saying is there are all of these parts that go into a trade, and there's a logic to each of the parts, and there's a balancing of the parts that lead to a true high probability trade, and that's what you see here. So price came up, picked up our order at 37.56, dropped down, just missed our stop at 37.47, and made a move up to 37.65, actually hitting our profit target by 1/10 of a pip. But we don't care. It worked. So this is something we use all the time. And if you really focus closely on what I do, you'll see that I'm not trading candles or chart patterns or indicators. I'm trading human behavior. And so when you watch what I do, you're watching an entirely new level of trading. No one taught this to me. It just comes from years of experience of watching human behavior patterns. Okay, now we need to begin with the settings. So the first thing I'm going to do is I'm going to move this. I'm going to move to just an open space on the chart. Let me maybe zoom out just a little bit. Just open space on the chart, and I just want to draw the fib tool. And so I'm just going to do that. This is the direction of the trend. Let's drop to a 30-minute chart because that's where our trend is. You can see the trend is up. And so we're going to draw the Fibonacci. Now I'm going to come back to this, but I drew this in the direction of the trend, and I want you to notice that the first number it comes back through is the first number it comes back to is 23.6, then 38.2, then 50%, then 61.8, and then 76.4. So always from left to right, always in the direction of the trend. All right, so let's take a look at something else. I've put the settings on here for you so you can pause the video and write them down. There's an ongoing debate about whether to use the last one, 76.4 or 78.6. Because most of our numbers originate from golden ratio and the Fibonacci sequence, I could show you how to divide all of this and arrive at these numbers using the Fibonacci sequence, except for maybe two. But I can tell you, here's the point. I've drawn tens of thousands of these. I don't know how many, maybe hundreds of thousands. And provided that you start and end your fib in the correct place, 95% of the time, it will be 76.4 right here. That's relevant. And I'm just going to leave it at that because I could talk all day. Okay, now let's cover the first two simple rules here. I follow my mouse here. Always draw from left to right. So write these down. Always draw in the direction of the trend. That's rule number 2. And I referred to those just a bit ago. Okay, now the third rule is very simple. The end point, in other words, if you're starting the fib, you can see my mouse here, and I'm ending the fib. The end point, whether you're drawing it up or down, is the high or low price movement of the trend. So in this case of an uptrend, it's the highest price that price reached. If we were drawing it down, it'd be the lowest price it reached. So it's very, very simple. The fourth rule takes a little bit of practice, but is not subjective. So there's very little of what I'm going to share with you today that is subjective. And what that means, it's all defined. And so what that means is that we should all be starting and ending our fibs in the same place about 95% of the time. Sometimes, maybe the start point could be 2 or 3 pips different, but 95% of the time, it's going to be in the same spot. And that's really important to understand because so much of trading is subjective. And so when we find something that's really not subjective to each individual person, then boy, we really want to latch on to that. Okay, now the fourth rule down here, start point is where momentum begins that breaks the higher low. And by that higher low, I mean the trend's only gone so far. A new wave starts advancing the trend up, like we've been watching with that trade our traders took. And now it's breaking a new high or low. Okay, so that's your 4 basic rules. Okay, now let's discuss some basic behavior that we'll observe repeatedly from the buyers and sellers. This is an important point of logic that I'm going to share with you right now. I mentioned it a little bit earlier, but I'm going to mention it again. Watch my mouse here. And again, let me repeat. Logic comes from human behavior. And as I said earlier, what I'm talking about here is the most reliable and repeated pattern in Forex trading in terms of human behavior. So if price advances, it is likely, and by advances I say advances the trend, if price advances, it is likely to pull back and push again. Now let's show that on the trade we were looking at. Here, what we're saying is the trend was moving up, it made it as high as this, and now it's advancing again. This is a new wave. So it's advancing again, and what we're saying is it's likely to retrace and at some point push again in the direction of the trend. So that's the behavior that we're trading. That's the core logic, one of the most repeated patterns in Forex trading. And keep in mind, you have to have a lot of things in place, but as long as you know what all the pieces are and you know how to balance them, basically trading setups become a lot easier. Now, with respect to the Fibonacci tool and the buyer and seller behavior around that, they have some regular behaviors there as well. So what I'm referring to, follow my mouse here, number 2, profit-taking levels are 23.6 to 38%. So basically that's referring to as they're making a move in a direction, they'll tend to take off some contracts, take some profit, and then recommit and move in the direction again. And so natural profit-taking levels are 23.6 to 38.2. Natural correction levels are 50% to 61.8%. And just jot these down. And the wave turning point is 76.4%. This is basically, for example, if you just imagine that trade that we took where it went up and back and pushed again, had it crossed down under 76.4, basically the sellers would have said, no, we're totally rejecting this. Okay, so that's the turning point. If they close down below 76.4 and stay there, it's probably all going to reverse. But that's a subject for another time. Now there are more behaviors, but while you're en route to your first goal of consistent profit, this is good enough. Experience will teach you when price is likely to retrace more or less. So if it's very bullish, it's likely to retrace less. If you're coming into a kind of a clear support or resistance area where prices stopped before, it's more likely to retrace more. If you're in a new trend, it's more likely to retrace more. And so these are the kinds of things, you don't want to try to learn 400 things, right? These are things that you'll learn along the way with experience. What you want to do is you want to learn enough so that you can achieve the first goal, which is having all the skills necessary to make consistent profit. Okay, context, the word context means a lot to me. I'm putting my mouse by it here. Context of what we're doing is we're always looking for what we do, what we look at in the chart is always in the context of a high probability trade. You'll never hear me go, well, we've got resistance at 13200 followed by a higher resistance at 13354. You're never going to hear me talk about that. Those are analysts. Everything I'm looking at is a story that either is a trade developing or leads up to a high probability trade. And again, I don't deal with low probability trades for important reasons. Now the other context, we've got to choose a context, a framework in which we start to evaluate the market and make decisions. And another way of me saying this is in order for me to show you how to best use this tool, I have to give you a great context to use it in. If you just go use it on a 5-minute chart or a daily chart, you're not going to get the same results. So we definitely want to use this in the context of a trend, and in order for you to be able to see a trend, we have to pick a time frame and a way to define that trend. Though I began 10 years ago as a position trader with daily charts, because of the uncertainty in the financial world, in 2009 I had to change to 30-minute charts. And I suggest you use these because the daily is going to be unreliable. So are the 4-hour. But when the world thinks there's a long-term financial future for the world, I'll definitely go back to trading longer-term charts. And yeah, we could be emerging into something like that now, but it usually takes some time to establish that fact. So I've switched back to the charts. So this is, if you can see here, it's a 30-minute M30, and that's minute 30. So it's the 30-minute chart, and this is where we would always start. Although you saw me drop down to the 5-minute, and I'll get to that in a little bit. So the 30-minute trend. So the next thing you got to know is we're on a 30-minute chart. We need some way to define the trend. So that's going to be the 21 right here and the 55 exponential moving averages. If the 21 is below the 55, we're in a downtrend. If the 21 is above the 55, we're in an uptrend. Now you can make these different colors so that you know what they are, but I know that the 21 always changes direction faster because it's using only 21 periods to make a movement, whereas the 55 is not making any movement until there are 55 periods factored into the equation. So the 21 is always moving faster. So you see it moves, it makes faster turns, and so on. But the main thing, if the 21 is below, we're in a downtrend. If it's above, we're in an uptrend. So now we know how to identify the direction of a trend, but we need that other piece. We need to see a trend advance with a pullback, and this is where the fib tool shines. And just let's look at it again, just real quickly. Here's price on the move up. This is a 30-minute chart. Right here, let's say we were watching the market right here, we see price start to advance. So it's at that moment in time that we would drop to the 5-minute chart. And we're not trading the 5-minute chart. What we're doing is we're zooming in on price action. So we want to see what their behavior actually was. I mean, we see different behavior on a 30-minute than we see on a 5-minute. And we want to know, did this push all the way enough for a trade, and did it not pull back yet? And it didn't. So we would have been watching, actually I think I was looking at this area, this came up, pulled back 38.2, then pushed again. So if you missed this one, you've got this one now advancing up, and then you could begin looking for a trade. So the point is on the 30-minute, let's pop back to that, you not only need the trend going up, it has to be advancing. Price must be advancing the trend. And there's a lot of traders out there who will tell you that moving averages are worthless, they're lagging, what have you. Sure, if you don't know what I know. If the trend is advancing, the moving averages are 100% accurate. Yes, if the trend's sideways and price is not advancing, the moving averages are totally useless. but in the context I'm using them, they're 100% accurate. Let's go into more detail and define a new wave. So right here, look at my mouse. A new wave, retrace 38.2 or more. So these are the rules for what defines a new wave. It retraced 38.2 or more, and then the wave advances price from the former trend high or low. So going back to our picture here, let's say we were looking right here and price was making this move up. So what we would be doing as we followed this price up, we would be asking ourselves, see, if we just got to here, did it retrace 38.2 or more? It did not. And so it continues on up, and we say, did it retrace 38.2 or not? It did not. And so this is where we'd be starting to look for a trade. And here's where it does hit 38.2 or lower, or more, we'd say. And so this is what we're looking for. So that's kind of showing you new wave. It takes off right here. The start point is the momentum. If this came back here, we wouldn't start it here. We'd start it over here. So starting point of momentum, it breaks the former trend high, and then it keeps going, and it has not pulled back 38.2 or more. That is a new wave. Once it pulls back 38.2 or more, the new wave has been created, and now we're in a pullback mode, and that's where we would look for a trade. Now I'm going to share just a couple more things with you here. I told you there were a number of parts that went into a high probability trade. I did mention risk to reward ratio. Range of advance is important. And so range of advance is 20 to 25 pips from the start to the end of the new wave Fibonacci. Okay, so let's move this out of our way. So what we're talking about here is price not only advancing the trend, not just that it has it not retraced 38.2. That doesn't make much sense, does it? It hasn't yet retraced 38.2, but it also is stretching out at least 20 to 25 pips. And so we can, go from the starting point of the fib, breaks the high, and we're looking for 20 to 25 pips or more. Now, if the new wave is, say, 50 in a 5-minute candle, we start to violate logic because a 5-minute move and a 50-pip candle in 5 minutes would be unusual. And remember, logic is based upon what's usual, so it's very important. So you're looking for this to not just advance, but advance 20 to 25 pips before it pulls back to 38.2. And the reason for that is, and you'll really understand this more later as you work with me, but the reason is you got to have a range big enough to get in and get out. If the target was here and you needed to put your stop below here, and there was only 7 or 8 pips, it's just too small. Any small movement in the Forex market just stop you out and have nothing to do with speculation. So there needs to be a pretty strong movement, at least 20 to 25 pips. And the last piece was optimal risk to reward ratio, which is 0.75 to 1. That's a story for another time, but there is no more high probability target. No higher profit target than 0.75 to 1, just years of experience. Also, something that comes up is trade pullbacks of 38.2 or more. We wouldn't trade 23.6. It has to pull back 38.2 or more. Okay, let's walk through this just a little bit more again. We determined that the trend direction from the 30-minute chart. We determined the trend direction on the 30-minute. But to observe the behavior that actually happened, we absolutely must drop down to the 5-minute chart, and you see me doing that. Now, people do get confused. Remember, I'm trading this behavior pattern: up, down, up. So price move, pull back, second push. It really has nothing to do with time. It just has to do with when price moves in a strong direction, it's going to pull back and push again. It's just basic human nature. So on a 30-minute chart, if we were looking at this on a 30. Try to imagine that on this candle where my mouse is, we can't tell if that pulled back all the way to here and then price went up here before it closed. We can't see that. We have to zoom in farther. So that's why you have to drop down to a 5-minute because we have to see what they did. Now this price might have pulled back to here on the 5-minute. It didn't, but it could have, and we wouldn't have seen it, right? Because we're not trading candlesticks and gimmicks and indicators and symbols. We're trading the actual behavior that happened. This is the behavior we're looking for. Strong push, pull back, second push. So all we need to know is, did that happen or not yet? And that's why we drop to a 5-minute chart. I think it's not too difficult to see that there are a number of factors that go into a high probability trade. Your job is to know what they are and to balance their relationship with one another, just like you do in ordinary life. You know, you might want to play that again. You know what? I'll repeat it. You can see that there's a number of factors that go into a high probability trade. Your job is to know what they are and to balance their relationships with one another, just like you do in ordinary life. So just imagine, I tell you, I can't meet you at noon because I'll be picking my kids up from school at that time. I'll have coffee with you at 3 p.m. because that's too late for lunch. We eat dinner at 6 at our house. So you see, you're trying to balance all of these things in ordinary life. So present in that example are the elements involved and the balancing. And so Forex trading is no different from ordinary life, even though people want it to be. So the trick in a high probability trade is knowing what the parts are and the relationship to one another and balancing them. If you were wondering if, I really know what I'm doing, I just told you the truth, and there's a part of you that just resonated with. Now, as I said, we don't usually enter at 23.6 here. That's the first profit-taking level. A lot of big traders like to just push it right to 38.2 and then push again in the trend. Now, this is the behavior that repeats, as I said, the most in Forex trading and what you want to be looking for. Price move, pullback, second push. I mentioned this behavior a lot of times here. This is the core logic that you're employing. Now, one last thing. I have a specific rule for starting and ending that fib. I promise you, it is no accident that this price hit exactly to the pip on my line, and I had this line in place long before price ever got here. That is no accident. That's not a fluke. It's not something that happens some of the time. It happens all the time, and that's why I told you need to use 76.4. Now, I've got something very special I want to share with you right now. If you're serious about becoming a successful Forex trader, then you're going to want to know how all of this works. I mean, how could you make a long trip, a long distance to a new place if you didn't have a map? And don't imagine that people are just out there showing you how to do it. Most of them are not. Now, I have two other things I want to share with you that you're going to love, but let me share the big thing with you first. I'm going to do something that I've never done before. I'm going to meet with you for free. And I'll do this if you're brand new or if you've been doing this for 8 years. Maybe you've been doing it a lot of years, but it's still you're not getting the results you want. When we meet, I'll get an idea about your experience, and then I'll tell you exactly what you'll need to do to go from where you are to consistent profit making. So I'll map that out for you, and I'll do that absolutely for free. I meet people all the time who've lost $10,000, $20,000, $30,000 and more. If they would have talked to me first, this probably would not have happened to them. If you've been doing this for years and you still can't make it work, I'll explain why it's not working for you. If you're brand new, I'll show you baby steps to get you up and going in a single day and moving down a good path. How can you possibly lose with an offer like that? My website is forexartofwar.com. That's forexartofwar.com. And you might be watching this video on my website, but if you look over here on the sidebar, right here, you'll see this graphic. All you got to do is click on it. It'll bring up this page, and here's where you register. The public has had access to my book, The First Battle, for some time, but no one has ever been given access to my book, Seize the High Ground, except for the members. And I wrote this book around 2010 or so. Seize the High Ground, and that's this book in the back here, is going to show you exactly where the market is most vulnerable to profit using the technique I just taught you. Now, I'm pretty sure you're going to love it. But like I said, up to now, only the members have seen it. So let me tell you how this works. When you register here and fill out this form to meet with me, you'll receive an email. Then what you want to do is go to your inbox. You'll see an email from us saying, hey, you need to confirm your registration. When you do that, you'll immediately receive another email with links to both books. So you don't have to wait to meet with me to get these things. They're just going to come to you right away. So click on this now, register, and all of this is yours at no cost at all, and I'll look forward to speaking with you.